Good morning, everybody, and welcome. My name is Anthony Kazazis, and I would like to thank you all for registering for today's webinar, sponsored by Next Generation Trust. My name is Anthony. I am the director of the NYC Network Group, as well as the NYC Real Estate Expo. Today's webinar is a panel discussion on self-directed IRAs. Real estate experts share real-life investment strategies. Our sponsor today is Next Generation Trust. Next Generation is a custodian and administrator for self-directed retirement plans, which allow investors to diversify their portfolios through non-traditional investments. These non-traditional investments are non-publicly traded alternative assets, which include real estate, private equity, notes, loans, cryptocurrency, precious metals, and more. Next Generation Services is the administrative arm of the business, while Next Generation Trust Company acts as the custodian for all accounts. Next Generation Trust Company is licensed and chartered in Sioux Falls, South Dakota. Its administrative office is headquartered in Roslyn, New Jersey. Next Generation's mission is to provide white glove customer service, ensuring their clients have the tools and support necessary to control their financial futures by investing with self-directed retirement plans. They fulfill this mission by educating individuals and their trusted advisors about the many options and benefits of self-direction, and guiding their clients through the setup and investment process. Our moderator for today's panel is Brittany Melville, Next Generation's Director of Marketing and Sales. Brittany applies her extensive experience in direct sales, marketing, and customer relationships management at Next Generation. In her role, she develops and oversees the marketing strategy across all media and works with the team to support sales initiative. Her panelists are Kaylee McMahon, founder and principal of Apartment Queen, Louise Zamora, Director of Investors Relations, Upside Avenue, Navid Moosa, Real Estate Agenteur for Mr. Save a Home, and Jasmine Willois, President of Note Assistance Program. Let's start off with Jasmine. Jasmine, can you give us a short little 1 minute or less short bio on yourself?
Of course I can. Thank you very much for having me. Can you guys hear me okay?
Sure can.
All right. I'm one of the few people stuck in the last moments of quarantine. So I'm out here in San Diego, in my backyard. My name is Jasmine Willois. I am the president of the Note Assistance Program. Thank you, Anthony, and New York City Networking Group for having us and being so gracious to host this event, and welcome myself and the NAP Nation out there. For those of you who don't know, the NAP Nation is affectionately the community that is behind the Note Assistance Program. I'm also the co-host of a podcast called the Naked Notes Podcast. You can find it on any of your favorite places that you download things like iTunes and Spotify and places like that. But the Naked Notes Podcast talks to you about education for mortgage note investing. And that's my specialty. So that's what I'm here to talk about. I'm originally from New York, so that's why I know everybody out here. I frequent New York on a monthly basis because you know what? You gotta love it, right? Gotta love New York. So that's it. Thank you very much. We invest nationwide, and I'll see you soon on the panel.
Oh, Jasmine, great. And we love your hat too, by the way. Kaylee.
Howdy, y'all. I'm Kaylee McMahon, founder of the Apartment Queen and Apartment Queen Investments. We've got 64 million assets under management in apartments, just like this one you see behind me. This is in Phoenix. And so what we do is we do value add to all of our apartments, and then basically at least double our clients' investments in our projects. I also have a podcast called Number One Leading Ladies. I also am in charge of a group in Dallas called Women Who Invest Wednesdays, where multiple different women who invest in different types of investments get together and we do kind of a brain share or mastermind, if you will. And then if you'll check out my website, there's a lot more information that we have to offer, but essentially we flip and add value to apartments.
Thank you very much, Kaylee. Louise?
Thanks, Anthony, for having me. My name is Luis Zamora, and I'm the Director of Investor Relations here at Upside Avenue. Upside Avenue is a product of the Casoro Group, an 18-year-old investment firm based in Austin, Texas. Upside Avenue is a multifamily focused REIT in the US South. We've been going for about 2.5 years now, and we have about 13 properties in the portfolio across the US, mainly focused on the Texas area.
Thank you, Louise. Navid.
Hi, my name is Navid Moosa. I'm from the Philadelphia area. I'm founder of navidmoosa.com. I teach brokerages on how to help their agents deal with investors for IRA investment. We teach teams, we teach individuals. I'm also have a podcast called Navid Moosa, The Mindset Movement. I'm also co-founder of a website called TrustDiaz.com. We have business in a box solutions for agents to become investors and entrepreneurs, besides just agents. And I also been dealing with investors for about 20 years, and we've been doing with IRAs investors for about 15 of those, and we have roughly $55 million worth of assets.
Thank you, Navid. Ladies and gentlemen, without further ado, we have our moderator, Brittany Melville.
All right, thanks everybody for joining us today. This is part 2 of a 3-part series. So last month, I talked just about self-directed IRAs 101. What are they? How do they work? What can you invest in? What are some of the rules? So today I'm going to give you a break from listening to me talk, and we're going to hear our esteemed panelists talk, as I'm sure that you'd like to learn more about some more specific ways that you can invest with self-directed IRAs. And of course, everyone's here also to learn about real estate. So we have a diverse set of perspectives and experiences here to share with you. So we're going to jump in. I'm going to start with some questions for Kaylee. As we had said today, we're going to be focusing on apartment building syndications and then REITs, mortgage notes, and fix and flips. So Kaylee, let's start with you on the apartment building syndication side of things. Can you talk to us about what are some trends in the distressed mortgage notes world, and what have you done to prepare?
I have to write that down. So if I squirrel, I know what to come back to. What I've seen so far as distress really was predicted by one of the chief economists that's inside actually Hillwood Group, which is a Ross Perot company here in Dallas, Fort Worth. And so someone that's been able to predict the last couple of recessions that we've dealt with, it told me last year that in about 6 months, so now-ish to about June time, we're going to start seeing some true distress. And that really has to do with not everybody, but some individuals choosing to take advantage of forbearance and be able to kind of kick the can down the road, if you will, when it comes to paying for their mortgage. There's been quite a few individuals that had some mortgages that originated by Arbor Mortgage that I'm seeing that are almost in pre-foreclosure because they had a little bit too high of leverage. So that was very important that you have extra cash reserves, that you have less than 75% leverage typically to stay out of kind of that risk zone. And whenever you get into a situation where you have tenants that are not paying or your collections aren't great. So that's obviously been happening for quite a long time. And it's not as bad here as it is in some other areas or states that are a little bit less landlord, tax, and business friendly. But here, because I focus in Texas, we have a couple properties in Phoenix. Those areas are seeing some effects. And because of that, as far as some distress is happening with certain companies, and it really just has to do with there not being adequate reserves and too much leverage on those loans. So that's kind of what I'm seeing right now. And now that we just had the moratoriums extended again, which of course we all predicted was going to happen, I am really excited, to tell you the truth. I've got a fund to answer the question about kind of what we're doing to prepare for that. We've got a fund that I just reached out yesterday to everybody and I said, look, if you just got the news, the new moratoriums, and you're freaking out that you can't collect, or maybe you're not sure what's going to happen next. We're targeting especially secondary markets where it's a post-COVID affected apartment building. So then we're able to get in at a decent buy-in basis. And when you buy the property at the right price, that's when you're always going to make a profit. So that's what we've done to prepare, and that's what I've seen.
Great, thank you. And on the lending and leverage side of things, if somebody wanted to use a self-directed IRA to do that, how would that work with you?
So if somebody, let me rephrase the question. So if somebody is wanting to use a IRA to lend or to be a limited partner?
Let's go with the lending aspect.
Sure. So that would have to be a big IRA, like a huge IRA. So if somebody wanted to do that, we could definitely do that. There's a couple different structures that we can put the capital stack together with, like, for example, preferred equity. that's someone that can come in and basically they can be a type of lender with our projects. And we typically leverage these assets using Fannie Mae, Freddie Mac. Not always. Sometimes I have to use bank debt, but point is there's usually a loan and a primary lien on the property. So that's one option. And then again, like I said, if it's a huge self-directed IRA, then they could even possibly be a private equity position lien holder. So it just depends on kind of what they're working with. But just how you're kind of able to private lend to flip houses and things like that. You could do the same thing. We just have to work with 3 attorneys that we have and set it up.
Got it. Okay. And what types of entities can invest in a syndication, and how will that work?
Yeah. So what I've seen so far on our capitalization table, I've seen trusts, I've seen individuals, I've seen IRAs that obviously it's listed by the custodian's name that's in behalf of, or sorry, for the benefit of FBO. What else have I seen? It's basically, it's called a EQRP, but that's kind of the same thing. And then a 401k, that's another thing I've seen listed on our cap table or capitalization table. That's what I've seen so far that I've been able to work with.
Great. Yeah. So it's not just limited to, using personal funds or personal accounts to get some investments done.
And actually being able to have kind of like a holding tank, if you will, reduces your liability. So it's also a great thing. Even though passive investors or limited partners don't have nearly as much liability as we do as general partners, it helps. And then also just to be able to protect yourself and protect your other businesses, entities, family, et cetera. It's a good idea to kind of have like a pass through.
Gotcha. Okay. And why should individuals want to invest in this type of asset? What's the attraction?
Yeah. So a lot of people are attracted to multifamily real estate because there's a lot of things like, for example, tax advantages. So we do some things currently, this may change in the future, but currently where we have depreciation like you normally get on a single family rental that you might be invested in. But we have bonus depreciation currently that we're able to take. And so, for example, on a property that I closed on in December, our year 1 depreciation, and it was a really small asset, to tell you the truth, it was just like 24 units. But that one we were able to take $900K year 1 bonus depreciation. And because all of the shareholders or owners in the asset, which is all of the limited partners and general partners, we all own a percentage, basically a percentage of that depreciation and bonus depreciation they get to take towards their other taxes, their other income. And depending on the type of income that you have, so if you're an active real estate investor, you can offset, you don't have a limit to passive losses. So you can offset a lot of, if not all of your active income taxes. Just depends on what you do for work. So there's a lot of tax advantages. Also, the K1 income, some investors who maybe it's their first time investing in a multifamily asset, they see their K1, as we call it. So the type of return or the type of tax document that they get, and it's got a negative 28K, and they're going, what is this? It's passive losses. So it's a paper loss, and it's actually a good thing. So that, like I said, it helps you save on other taxes. And the great thing, like there's some other options that are out there where typically the taxes are passed down to the shareholder in that type of investment, where, for example, they would actually have to be taxed at ordinary income tax rates. And so that's much higher than you'd be taxed if you were making K1 income. And so it's a great way to make passive income, lower your taxes, and be able to take essentially extra tax benefits. Another reason why people like to invest in apartments is because you're also able to get cash flow and appreciation. There's a lot of asset classes out there where maybe you just get the cash flow and you get a little bit of the gains and that's it. But when you're invested in these projects, not every single one of them, but some operators such as myself and my partners, we offer both to our investors. So meaning that when the property is making money over time, we'll be able to distribute that cash out to the investors. But on top of that and the tax benefits, whenever we sell, there's a large gain typically, but we at least double what we went in for. And so everybody gets a piece of that. So you get the cash flow and the appreciation, and the appreciation is so great because you do it by multiple. So it's by a business income is how it's valued. So basically, if I put in, like, I'll give you an example, we put in some storage units for like 19,000 on a property based on the compressed cap rate on that project. We ended up making 120K like that, just based on the value that new installation of storage units gave us. So we can also multiply that by so many more things. But point is on a multiple of, if you have 200 units and you save $10 a month per unit, multiply that by 200 units, whenever you're increasing income or decreasing expenses by that multiple every month, you can see what that would do then to the net operating income and the value. And so we can really just ramp these things up pretty fast. Great.
And then of course, if you're using the IRA as that vehicle to invest, you're automatically getting that tax shelter as well. So either way, it sounds like there's some tax benefits. And to invest with you or generally in this, do investors need to be accredited?
Not always. So we've got a couple of different options. Like on my website, on the top tab, it's got we've got one option. It's a fund, for example. And on that one, you do need to be accredited. And that definition did just expand. So there's 12 million more households that are accredited, plus people that are financial advisors that have I think it's Series 6, Series 7 tests, have knowledge of funds, certain other things, you're considered accredited. But we have other offerings as well on the website. There's a quiz that there's a button that follows you around to get qualified for future investments. And that will put you on a wait list, because we can take up to 35 unaccredited individuals on deals. But there's just a ceiling for it, and you have to be qualified and self-certify your knowledge basis and how you know me and some other things. So we can take both, but just under certain circumstances.
Gotcha. Okay. So it's worth definitely looking into it or going through the process.
And I'll add, just because I'm so excited, that on the 15th of March, regulation crowdfunding just changed. So it was where we had a max of $1 million we could raise, and now it's 5 million. And I have been waiting while launching this fund to do a side-by-side crowdfunding offering. And so once that is done in like a week or two, hopefully, then we can take people that are non-accredited and non-sophisticated, like my grandma, and the minimum on that one's going to be like $1,000. So if you're aware of Kickstarter, Indiegogo, things like that, and you want to invest in a startup, essentially, that's an opportunity that you can actually do it, but just do it towards real estate. So that will be coming soon. It's just not available yet.
Awesome. I did not know that. So very good to know. Thank you. Thanks, Kaylee, for all your insights. We're going to move on to REITs with Luis. So Luis, can you talk to us a little bit more about the REIT structure? What is a REIT and what is multifamily as it relates to that?
Sure. Thanks for having me, Brittany. So our specific REIT is called a non-traded public REIT, which means that we have to file with the SEC. However, we're not traded on an exchange like the public REITs that you see on, the markets, NASDAQ or the New York Stock Exchange. Basically, we have the ability to raise capital. However, we don't have the constant changing of share price or constant exchanging of shares between individuals on these indexes. The REIT structure, though, is an interesting tax structure, which basically means that 90% of our income is actually paid out to investors each year. That's our legal obligation. However, it's different than other real estate funds in the sense that we have the ability to raise capital from non-accredited investors. Our minimum investment is $2,000. And the reason why we have that minimum investment is so that we have investors coming in that have the ability to access institutional quality real estate deals that didn't have this previous access before.
Great. Excellent. And with a REIT, so if I invest in a REIT, whether it's with my own funds personally or an IRA, am I investing in one property or multiple properties? What am I actually holding?
Right. So REIT structure is kind of set up like a mutual fund. You're not directly purchasing a property. You're purchasing shares in a portfolio of properties. So our specific REIT focuses on multifamily in the US South. We used to focus on value add, but we've currently analyzed trends specifically in the US South and have kind of focused on a different asset class. And that asset class is A-B+. So previously we were targeting workforce housing. And the reason for that was it was super stable. There was constantly a necessity for these apartments. But we've kind of noticed that it's becoming super expensive to maintain these apartments that were built in the 70s and 80s. And we kind of are now focusing on these apartment buildings that are built in the 90s, early 2000s. The reason for that is there's a constant flow of what we call a knowledge worker moving to the Texas market. This is because companies like Oracle, Apple, Tesla are changing their headquarters essentially to Texas. And so all of these people need somewhere to live, right? So we're kind of following the trends of multifamily and focusing our outlook kind of on the future. And we see this as a great opportunity to get into this new asset class inside multifamily.
Very interesting. And in REITs, what are the returns typically like? What can an investor expect?
Right. So Kaylee kind of mentioned this earlier. It's a similar thing. You kind of have two sides of the return. You have that cash flow that's coming in from the monthly income from rent. And then on the flip side, you have the appreciation, or when we officially dispose of the asset. So we're kind of looking at, our target is 4 to 7% quarterly annualized from the REIT in terms of cash flow each quarter from rental income. And then we target around 6 to 8% in the form of appreciation when we dispose of an asset.
And what is the liquidity like for that?
Yeah, so one of the things that our founders really wanted to emphasize was the longevity of real estate. It is not a quick buck. It is a hard asset. When you're investing in a property, you're investing in a physical, tangible property. You're not investing in a stock, etc. So we like to say that the minimum investment for an investor should be around 3 years. The reason for that is when we purchase a property, when we do our value add, we're really not looking to sell that property until the minimum 3-year mark. So you're not going to get your return on the end. On the flip side, when we sell the property, if you're not in the fund for a minimum of 3 years. So that's why we say there's a minimum of 3 to 5 years for an investor. However, we do have liquidity options after a year. There's just a fee associated with that, just so we discourage people from doing that. We really want to emphasize the longevity of the real estate investment, understand that this is a 5-year play max, and that we have options for individuals that do come into a hard circumstance like COVID, for example, where people did need access to capital immediately.
And can you lastly just talk a bit about your experience with working with IRA investors in this space that use their retirement accounts?
Right. So piggybacking off what Kaylee said, there's so many good tax benefits using your IRA account. And what I've noticed working with individuals that use their IRA, they really understand the longevity of real estate as an alternative asset play and really want to maximize their returns in terms of tax advantages. And so, there's 2 ways that you can do it. I've seen individuals that use custodians like yourself, Brittany, and they create their own SDIRA account, or there's other individuals that have created LLCs through their retirement accounts that then have the ability to invest in our product. Either way, you still get the tax benefits, and either way, we still accept those kind of investments. And for the most part, I find those individuals to understand the real estate play a lot better than individuals that are just coming to understand it and are using their own, checking account, savings account to invest in us.
Thanks so much, Luis.
Thank you.
All right, let's move over to mortgage notes with Jasmine. So Jasmine, are notes considered an alternative investment that qualifies to be put in self-directed IRAs?
Yes, good morning. Good morning, everyone. Can you hear me okay?
Yes, we can.
Wonderful. I always have to check that before I get into it, and I find I'm on mute, right? The Zoom nightmare. So yes, what I love about mortgage notes, just like every other investment on this panel, and that's bought here, they're considered alternative investments, and so they can fit very neatly into your self-directed IRA. And that's why I love to be invited to this this webinar here with Next Generation. We specialize in helping people find monies to invest in. And just like Luis said so eloquently, we do not suggest you take your grocery money, as we like to call it, and invest in the long-term assets of mortgage notes, right? Because this is a long-term mindset you'll need with that. So what we do is we walk around and help you find money from old past jobs that you might have had. A lot of us here are seasoned, and this is not our first time at the rodeo. We've had multiple jobs before. So we'll sit down with you with experts like Brittany at Next Generation and say, hey, do you have anything that you can roll over? And a lot of times you will be surprised that you'll find a nice chunk of money that you can roll over and start investing with. So that's why we find ourselves here with you.
What percentage of your clients are utilizing IRAs to invest in notes?
Oh yeah, great question. About 80%. I founded this company 2013, working with companies just like yours. So partnering with self-directed IRA companies is very huge for those of you out there even looking to use OPM. that's one of the things we specialize. So I have to take this moment to shout out my community, Nap Nation. I see a lot of you guys out there in the chat room saying Nap Nation. These are people who have successfully invested in mortgage notes, and they have used Next Generation and other people like that to use OPM, find other money as an alternative investment. A lot of your clients are like, hey, I'd love to start investing in mortgage notes. So they start to find out more about the product and then invest or JV with some of these community members, right? So yeah, you guys are a wonderful asset for people looking to invest in mortgage notes. We use it as a source of OPM. We use it as a source of just finding our own money and also just creating accounts with you guys. So if you have not already, I encourage you to find some money and roll it over to Next Generation and or create an account, because you'll be surprised at some of the creative ways that they have for you to save for your retirement. And our motto here is let no retirement account go underfunded.
Love it. And yeah, I love the unexpected guest we have, that bird chirping in the background. It's so
I knew he was going to show off today. I was like,
it really is calming. It's like Zen for this panel.
All right, good.
So my next question is, how much do you need to get started? If you're using an IRA or you're using your own funds, how can you get started?
Yeah, that's a great question. We actually have what's called a path of education. So Latrice Nervous, she's our executive assistant out there in the chat room. She'll put information on how to get in contact with her. But at the end of the day, what I can tell you is we only think that you need to put aside around $30,000 to $40,000 to get started with your first note. And that's going to include, believe it or not, education, right? We have a training program that'll cost you about $6,000 to $7,000, and that'll get you your first note training, so we can handhold you and walk you through that. So between $30,000 to $40,000 in an IRA, we can roll it over and get some training. Also purchase a note. Notes will typically run anywhere from $15,000 to about $25,000 to $35,000. That's what we suggest for your first note. Can you buy multi-million-dollar notes? Yes, you can. We have commercial notes. Those are some of our favorites. Apartment notes, like Kaylee says. Kaylee, if you have anything that's too distressed, like you said, over leveraged, call me. We'll buy it from you. But at the end of the day, notes, you don't have to have that much money to get started. And that's one of the other things about it. If you come to a place where you can cherry pick, typically this industry is reserved for bigger funds. You have to go direct to Fannie Mae, have $50 million to buy. That's where all the money is. And what we're doing here at the Note Assistance Program is we're allowing you to get access to some of the same inventory. Okay, we are in some trades just one seller away from Fannie Mae. Okay, so that's how direct we are. We can get you access to this inventory one note at a time, and you can still get bank-like profits. So that's what's exciting about it.
Great. Yeah. So what I'm hearing too is that you don't have to have, $500,000 in your IRA or your 401k to get started, or you could take even a portion of what's in, an existing retirement account and move it over. You don't have to move everything. So you can diversify, into some of these options. You mentioned training.
Exactly.
Forgive me if I missed it, if you already said this, but how much time do you need to get through the training in the first note if someone is a beginner in all this with you?
Yeah, no, that's great. What I would tell you to expect, basically with all this, your self-directed IRA, and why I like working with a company like you, is that this is money that you should not be fretting over, right? So invest wisely, but then sleep comfortably at night. So that's one of the things we want you to know. So our advice is you want to set aside, we say between 6 to 8 months is going to be the quicker side of things, but realistically 12 to 18 months, right? You can get a mortgage note from us, and many of us have. I see Tanya Brown out there. She definitely reach out to her. She's one with notes. We did a webinar with Anthony a few months ago, but she has an experience where she bought a note and received a payoff because the person refied within 3 to 4 months. I don't even know I can tell you what percentage, but definitely double digits into her retirement account. So the money in return goes right back into the account, and this is doing much more than the company matching that you're usually getting, right, at the firms and things like that. So what I can tell you is 6 to 8 months. On the good side, things can happen. Miracles happen all the time. That's why you buy as many as you can within your budget. But if you run into something, I had a note where I had a bankruptcy. The person filed bankruptcy 3 times. Took me 3 years to get out of the note. That's on the worst case. So I say saddle up for 12 to 18 months. That 3-year note, I got 165% return on. So I gladly waited that time. But you have to be prepared for the worst case, because as a bank, the worst case usually means more money for you. It's all about the amortization schedule.
Yep. So I think that with using a retirement account, it might not be as much of a concern anyway, with it being, held for more of the long term, or it's more of a long-term play. And even if somebody had, got that return in 6 to 8 months, went back into the retirement account, they could reinvest that into another one with you, right?
Oh, it's amazing. Yeah, it's amazing. That's one of the things they do. They also can JV. We have a lot of people joint venturing with a self-directed account. So you guys don't understand the resource the next generation can be for you. You can attend. I'm sure you guys, when things get up and running, will have certain events where your clients can mingle with each other. But you may find someone else who's interested in mortgage notes, and they may want to joint venture with you and your self-directed IRA on an investment with us. So yeah, the world is just an oyster when it comes to working with people like you, because that is the money that, like she mentioned, you're not going to lose sleep over. You just want to make sure you do the due diligence on the upfront, just like with everything here, and so that you're comfortable with your resources and your team behind you, so that you can get through whatever comes your way.
Awesome. And then naturally, usually the next question is, okay, how do I get started? What do I do first? So how would someone get started with all this?
Well, definitely, if you are looking for the money, first thing I would do is reach out to someone like Next Generation and find out if you have an old job, can you roll it over? If you want to get that started right away with us, you would reach out to Latrice Nervous, and I saw her put information in there, and she'll just walk you through the process. We have a free podcast as we would like you to get started. Just education first with the free podcast. It's Naked Notes. You can find it anywhere. Start with episode 1, season 1. We take it from the beginning. What is a note? What are you buying? But just like Lewis said, you need to know. With him, you're buying a REIT. With me, you're buying paper. So also not the asset. Some of these guys you're going to go get a knock on the door and get a key. There's no key coming unless you foreclose. And a lot of times that's one of the last ways you're going to make money. I have a gentleman right now who's helping someone stay in their home in Louisiana by using the rental assistance program that's just been released by the government. And so all that money, he's going to get close to $8,000 back in his IRA just from the government giving them their back payments. So this is what we're talking about: doing good, making a lot of money, and going to heaven and juicing up that IRA.
Awesome. Thanks, Jasmine. All right, last but certainly not least, Navid. Talk to us about more of the direct investing, or a little bit closer to the direct investing option. How involved does someone have to be if they're going to invest in fix and flips, through you using an IRA?
So a lot of my clients are the newer clients who have IRAs or don't know how to set up an IRA. So we walk them through how to set it up. Everything's through NextGen is what we use, preferred client of ours. And they can be as hands-on or as hands-off they want it to be. Our initial, when we started into this business, was, like I said, 15 years ago, and I was doing a lot of short sales and foreclosures. That was kind of like my introduction to real estate. So I got into that, and that's how I met like private money lenders, hard money lenders, and then that evolved into self-directed IRAs. And we created a program almost like a business in a box, if you will. And so what that was is an investor who wanted to just give us the money to invest for them. They just want to be hands-off and collect a quarterly check or annually check. That was really about it. We would do that. So we'd find the asset for them. We get it renovated. We get a tenant in there and get property management in place for them. And it'd be basically a turnkey. If they want to come down and visit it, they can. I encourage them to go do that. But because they're all over, whether it be Texas, San Diego, wherever, we FaceTime. So I'll walk through the projects, or my acquisition managers would walk through the projects with them to show them what we're working on. And that essentially evolved to almost like our promissory note program, because we would buy an asset for somebody, and then they would recommend a friend of theirs to ours. So we put them into something else. And they're like, oh, well, that's a bigger project. I want to get into that. And it was like, well, we need to sell this one here. And it was going too fast for us. We didn't know how to kind of like make everybody happy, if you will. So what we decided to do was put several businesses underneath one roof. So we have a real estate brokerage that I train all the agents to work with people who are new to IRAs, how to invest, how to discuss it, talk to them, and recognize assets. And then we would have, it may be similar to what Kaylee does or Luis does, where it's a 3-year minimum. You have to have it in. And then what we do is we just basically, you fund us the money. It's secured by the company, and we put it into multiple assets for you. It could be a multi-unit, it could be a single family, it could be commercial, residential, whatever it is. Some people like to come down and visit. At first they'll come down, they'll come check it out. And once they get the comfort level and say, okay, I know my money's safe, then they don't come down anymore. And that's fine. And I'm okay with that. I know I'm sort of a control freak. So I like to always be there and be involved with everything. And so I like to keep them involved. I mean, it gets to a point where sometimes some of the clients just say, we're good, we're fine, we're okay with it. As long as they get like a monthly update or quarterly update, they're okay with that. We don't really have to be accredited with us to deal with us, because we we deal with a lot of newbie investors to begin with, right? So, but there are changes. So like, I'm probably answer some of the questions that I've heard you ask the other panelists here, but we used to deal with people who only had like, let's just say, I don't want to say only, but $35,000. And that's a good chunk of change for a lot of people. That's a good chunk of change. However, the quality of the product of the single family home you would get at 35,000, the headache associated with that just wasn't worth it. So on paper, you could show like a 14% return on a Class C property because it looked great, but in actuality, you were maybe only getting like an 8 or 9% return, right? So some of the newbie investors who would watch these TV shows and HGTV and stuff like that and see all these crazy returns, and they say, well, I want to get this kind of return. I want to go to West Coast and get this, or down south. Hey, you can go get it there. That's fine. But I'm in East Coast, I'm Philadelphia, Pennsylvania area. I'm gonna tell you right now, I'm born and bred here. I know it's here. I know it exists. And so when they come to me and asking for a large return, I always say, here's my question to you. Do you want a 14% return 20% time of the year? Or do you want an 8% return 90% time of the year? Which one do you want? To me, it's all about consistency. So I'm not going to sit here, or none of my associates, are going to sit here and try to sell you this big old dream of getting this enormous return and stuff like that. It doesn't exist in some of the markets that we're in. We're just not that. Like the bigger markets with Jasmine and Kaylee and Louise, those numbers are real. What they're telling you guys, I have family in that market, so those are realistic figures they're giving you. Here, it's realistic, and that's why we deal with the newbie investors. Some of the much more the higher dollar figures, they don't like some of the returns that we get them here because it's not that high, but it's consistent and it's reliable, and they can come touch it, feel it whenever they want to.
Okay. Yeah, so it's a matter of what each investor is comfortable with and what their objectives are, it sounds like. And how much money out of pocket does someone need?
It all depends on the asset that we recognize with them, or we pair them. So like my shirt says Mindset Movement, and like my podcast, the Mindset Movement is, we don't just want your money. We want to sit and talk with you. And I don't want it, this may come off the wrong way, but I've turned away more people than I've accepted, because when I talk to them, they just want to get rich in 6 months. They just want to get rich in 3 months. That's just not realistic. It's just not. This market is always changing, especially now. And I'm sure my panelists here, co-panelists can definitely agree with this. This market is crazy. And Kaylee, I agree with that 100%. This can's been kicked down the road. So come June, July, I tell a lot of people, get your popcorn ready, because you can have that cash ready, because when it hits, it's going to hit. And I want you guys to be ready for that. So I can put you into this asset now at about 50, 60 grand, no problem. I can get you to that. Or you can just keep piling up your money, and we can get you to some really well-performing assets on a consistent basis for like 3 years and 4 years down the road, And so that's why we've kind of turned away the 20, 35,000 because of that class there, but they can get started right away. But we sit down, we interview with them, and we see where they want to be at and where their goals are at. And then we say, okay, we'll put you into the single family, or this 3 unit, or this 10 unit, or this, storage facility, or whatever it may be. But I can't say, here's what we'll do for you. It's a legit interview educational process, because I think it's Jasmine, one of them said it, I want to be able to go to sleep at night with no stress. And I can only do that if I understand your goals 100%.
Got it. And who would handle the repairs, eviction items, that sort of thing? If they're using the IRA to invest and that comes up, who's in charge of handling that?
So we have an in-house property management company, and we have several in-house contractors as well who give us like a preferred rate, if you will. And what we do is they'll handle everything: the eviction, the tenant placement, the repairs, the whole nine. And as most of the listeners know, the money that comes in from the rent, right, that money doesn't go back to the owner, it goes back to the IRA, right? That's where the funds go back into. So what we do is we collect the rent, and then we set aside like an X amount of dollars for like a repair fund, if you will. And that takes care of the repairs, that takes care of the evictions, if we need to file eviction and stuff like that. And then we're flexible with our clients, or with our tenants, rather, with our clients. So we'll fund some, we'll hold some of the rent money that comes in to take care of some of these things if it exceeds the reserve amount. And then when it's all settled up and we're zeroed out, then we'll put the money in. We don't like to bug our clients. We know they're busy, they have their 9-to-5 job. They didn't get into this to be a full-time investor or landlord. They got into this as passive income. Most of our investors do that. They want to be passive. So they don't want to be bugged, you know? So, and again, that goes back to what mindset do you want to be from the beginning? And our motto is, how do we say it? It's just discussion. That's it. We just want to discuss with you, want to talk with you. There's no commitment, you know, it's conversation, no obligation. That's really about the best way to put it.
It sounds like you take more of a consultative approach to working with investors and taking the time to fully understand their situation, what makes sense, what's going to make them happy, and whether, you know, there's something that you can work with them on that would fit that mold. And the investors that do work with you, how often do they get paid? So for example, if someone's investing with their IRA and they want to know, like, how often is my IRA going to get some cash back into my account, paid back? What does that look like?
Yeah, so if you actually own an individual asset, you get paid monthly, right? So as the rent comes in, you get paid every single month. If you are doing the notes approach, where you have your money kind of sitting all over, it's a quarterly payment. So you get a statement from us, and you get a quarterly a deposit that goes right in. So we just send it directly to Next Gen, and then at the end of the year, they'll get a statement from us saying, "Here's what we paid so far into your IRA."
Right, and to clarify, the payments that go back to an IRA's investment are sent directly to the IRA custodian for anyone who's unfamiliar.
Correct, right to the Next Gen account, FBO, IRA, whatever it is, how it's laid out, you know, QP, whatever, it goes right into that. And then there's people who do flips, right? For the flipping side, that's a 12-month, right? Because if we're going to flip a house for them, we make sure that we're in it, in an equity position where if we can't sell it, where we can then, we'll buy it off the investor. So if we'll put it on the market and flip it. If for some reason we can't sell it, we'll then go to a local lender that we have contacts with, and then just we'll buy it from the investor directly. So at least the investor is still made whole, and the agreed upon structure with the 10, whatever percentages is in the agreement, they still get that back. So if we can't find an end buyer, we are the end buyer then, and we'll hold it. And so we try to have 3 or 4 different verticals. Whenever we look at an asset for an investor, we don't just take one approach. We try to make sure we have multiple exit strategies for that.
Yes. And last question, which investments qualify for IRAs? Are there any that wouldn't work, or are all of those fair game for consideration?
They're all fair game. I mean, there's nothing that we really have, to be honest. It's at the threshold of the investor. Some of them want to do only Section 8. Some of them only want to do non-Section 8. Some of them just want to do 5 units and above. It's whatever they want. We'll look at them. Like I said, we will turn away, unfortunately, those people who just want to go, have a certain threshold. They want to be this kind of, respectfully, if I get the vibe you want to be a slumlord, I'm not just going to work with you. It's just not going to happen, because it's, at the end of the day, my face and my company's face is meeting with the judges and the tenants and the contractors. So that's the reputation I have to protect first and foremost. I got 2 kids and a wife, and if I piss them off, I'm screwed. So I got to make sure that we're all happy and stuff like that.
Happy wife, happy life, right?
Right.
All right. Well, thank you, Navid, for your expertise. And I'll just say that we've Next Generation has done, I think, with each of our panelists, we've done webinars in the past. We've done work together. I was on Kaylee's podcast, which is great. Jasmine, I'd like to get on yours, but I think we're still working on that. And Navid, looking at yours too. But we have done webinars that have dived more specifically into each of these as well. So we're all about education. Thanks everybody for your time and listening. I think we have, Anthony, some time for questions that may have come in that we can field to the panelists.
Correct. Yes, we do have some questions. You guys were all great, very informative information. Thank you. Our audience thanks you. And we also thank your bird, Jasmine, uh, some good info from that bird as well. Our first question, I think this is for you, Louise. Like a lot of investors today, I've enjoyed our booming stock market, but I have my concerns about having nearly 90% of my IRA in equities. As much as I like to consider some real estate diversification, I've heard that Kevin O'Leary, formerly of the Shark Tank, has sold all of his REITs and only has 8% of his portfolio in real estate. What are your thoughts, Louise?
Yeah, thanks for that question, Ron. The first thing I want to point out is it's really helpful to get investing advice from these, traditional investors that have made millions and millions of dollars. However, you have to understand that their advice comes from their expertise and their experiences, and they also have millions of dollars to throw around. I'm not exactly sure if Kevin O'Leary was invested in public non-traded or public REITs. There's a lot of issues with public REITs having extreme volatility. And so it's not really a tool for diversification that real estate is usually used as. But, you have to look at your portfolio and see what makes sense. If you are interested in diversification away from public markets, then real estate is an opportunity for that. And there's also other alternatives that you can look into if you aren't necessarily convinced by the real estate play. It just has to make sense for your portfolio, your risk tolerance, and what you're looking for. If you're looking for diversification in a REIT that has 13 properties in the Texas market, then that makes sense for you. But, take what Kevin O'Leary says with a grain of salt, because you aren't in his shoes and you don't have the millions of dollars to throw around that he does.
Good answer. Yeah.
All right, so kind of to piggyback for Louise, I think the average REIT nationwide basis only gives you I believe 5% return for the most part on a national stage. So when someone like him or that kind of who says like that, it's not knocking them, it's their marketing, their investment strategy. And right now, there's a lot more opportunity for direct real estate investing to get a lot better return, which is why he's probably why he's pulling it from that. But on national average, yeah, I think 5% of what a REIT's going to give you. But directly, to go to Kaylee or Jasmine or Luis or anyone from their panel here, you can probably get a much better return by directly investing with one of us or somebody similar to what we do.
Thank you, Navid. Thank you. Let's stick with you. I think this question is for you, Navid. How important is it to use someone like you when using a SDIRA? Can you highlight some of the restrictions specifically regarding sweat equity when investing directly in real estate?
So I would say there's no really restrictions per se, and I think Jasmine had touched on this earlier on. It's not, you don't want to use the money you put into this, you don't want to lose sleep over, right? Because it's not something you're going to recoup right away. So when you're renovating a property, I always try to buffer in a couple $1,000 just to make sure, which you're never going to find out what's behind the walls until you knock the wall down. So although we can do our best to budget into something, if the person wants to come down and get dirty and actually put their own time in to learn it, yeah, that's fine. But I guess the importance of the self-directed IRA is just to make sure you have enough in there to fund the just in cases that you're always going to find, no matter if it's a 1 unit or 100 unit place.
I can add to that as well. So regarding sweat equity, it is, as Navid said, it's okay if someone is using their IRA to invest in these deals. It's okay to go and oversee that property and visit it and check out what's going on. But if their IRA owns a property or a portion of it through this type of investment, the IRS won't allow that person to physically do repairs or physically add any value. So the fact that working with someone like Navid, for example, that is using a property management company, it's hands off for the IRA holder. And there's no concern with having to get involved to a point where you might be doing anything prohibited. And there are certain restrictions to be aware of. So it's important to note that prior to getting involved.
I was glad you brought that up. I was getting scared when I heard that. So that's one of the things that we love about notes as well. everything that we do is delegated to someone. We're not here to give you another job. You're going to have an attorney do the foreclosure. You're going to have someone else do the eviction, someone else do the paperwork. You're just going to do the due diligence, excuse me, on the front end. And then after that, you're going to have the right people with the right licenses and the right training and expertise to handle everything, even communicating with your borrower. So you have to learn how to be the bank. So if you guys have played Monopoly, if you don't know the name of that guy who just sits there while you guys play and he doesn't say anything, he just watches you, he's got that hat, his name is Uncle Pennybag. That's who you need to learn how to become. That guy who does nothing but just gets rich while everyone else is renovating stuff and buying properties. You sit there, you own the note, and you collect money.
All good answers. Thank you, guys. And everybody can answer this one. I struggle between the idea of using SD self-direct IRA to use investments, but can't access until later in my life and trying to make it an immediate income. How can I balance that? Is it worth withdrawing and accruing fees just so I can account the cash flow I earn from investments as income?
I can address that, and then if anybody on the panel wants to add to it, if we have time, that works. So often we do get this question about sort of, if my objective is I want some quick cash, but I also want to use my IRA, is that an option? One way that could potentially be achieved is through partnering with your IRA into an investment. Where essentially you would personally take some portion of ownership of an asset or piece of an investment, and your IRA would take its own separate portion, so that you're sort of attacking both objectives. However, it's really important to be aware that because the IRS does have some restrictions, they don't permit you to commingle your personal funds and your IRA funds, because one of these is a taxable person, if you will, or taxable individual or entity, and the other is a tax sheltered entity, the retirement account. So it can certainly be done, but those ownership allocations, if you personally own a piece and your IRA owns a piece, have to be completely separate. Everything has to be consistently allocated to each of those throughout the course of that investment. And then the IRA's portion of its investment would go back into your, for example, your retirement account, and you have that tax deferral or the tax-free earnings. And then the portion that you've invested personally, you can take, of course, yourself and utilize immediately. But then, of course, you're going to be subject to, whatever taxes might apply to your situation. So it's one way that you can sort of hit both ends. And sometimes for people, if they don't have enough cash in their IRA alone or personally alone, the partnering of the two can give you the opportunity to make an investment that you want. So that's one way to go. Kaylee has something to add.
Kaylee?
I wanted to wait and be polite. So I think that there's a couple of options out there when looking at alternative investments. If you wanted quick cash, I hate that phrase, but a quicker cash than 3 to 5 years type thing. Louise probably has an option. I probably have an option. In the apartment syndication world, sometimes projects, and not all of them, they're all different, will offer different classes of shares to individuals. So for example, you could have A1 shares, A2 shares. An A1 shareholder may just get the cash flow, and so they consistently get a monthly or quarterly or however it's distributed cash flow, and they get that part of the asset. Whereas there's some shareholders that get just the long-term gains and they don't get the short cash. Some opportunities give you both. So it just depends. And then usually with a REIT, usually like Louise said earlier, they have to give you legally and tax-wise, et cetera, they have to distribute that cash consistently. So there's definitely options out there for a quicker cash, I suppose.
Oh, thank you, Kaylee. Kaylee, we're going to stay with you. This question is for you. IRAs are insured. How does that insurance change when transferring your funds to work with a company like yours, Kaylee? Of course, all investments are not without risk, but how does your company migrate those risks?
Yeah, so mitigating risk, I could go on for hours about this, but there are certain things that we do in our underwriting, looking for certain types of assets that are typically they're highly They're not being built anymore, so there's no supply, but there's high demand. So that reduces the risk of vacancy. The types of areas that we're buying in, the markets, lower in crime. We see increase in income, increase in property value. There's certain metrics that we want to meet on every type of asset, which decrease the risk of the purchase in the first place. Then as far as a limited partner, for example, that's invested in the deal, again, whenever you're investing as a certain type of vehicle or a pass-through vehicle, that gives you some protection from separating it from your other assets that you have. But in addition, a limited partner essentially doesn't have any liability when it comes to being sued. We have deaths on the property, we have floods, we have arson. I mean, we've done all the things. Stuff happens all the time. But the active operators or general partnership team, we have to be the ones to deal with that. And sometimes whenever we're signing on a note, sometimes we're personally liable, the investors are not. So that's one way that is, I guess, as far as how you're investing, that your risk is limited. So, and then also whenever you're looking into the type of asset you're going to be investing in, the area, the hold period, and then the track record of the team, that all comes into play with what kind of risk profile you're looking at for that type of investment. And what I'm going to do for anyone that's interested in seeing future offerings is I'm going to put in the chat real quick a little quiz that can get you qualified for what may be coming down the pipeline in the future. And then you can take your time looking at the opportunities and vetting it yourself. Due diligence is definitely very important for the investor to do.
Thank you, Kaylee. I guess this could be answered by any of you guys. Real estate markets for this downturn, I don't see it happening in the tri-state areas like New York, New Jersey, Connecticut. Where are you seeing these 6 months downtrends you're expecting? Should I read it again?
Is that for anybody or just
I guess
anybody?
Downtrends. What specifically?
Did you guys mention something about downtrends before?
Oh,
Apparently,
I know. I mean, I kind of piggybacked over Katie's comment where in about 6 months, we're seeing these forbearances, they're getting kicked down the road, kind of where the forbearances are going to stop. And then the foreclosures are going to start, essentially, is what's going to happen. So I'm in PA, I'm in Philly. We're noticing that house sales are dipping, the pending status, active status, the different statuses. We're noticing a difference. I mean, inventory is still not enough, don't get me wrong, but we are seeing the increases not as much as what they used to be, the closing ratios and stuff like that. That's just here in again,
yeah, here we're seeing a 24% year over year still increase as of this month. And inventory is less than a month. It's nuts. Everyone is coming here from other places.
Yeah, so it all depends on where you're at. It all depends where you're going to be at.
I expect, I love economics. It's my background. I love studying it. And just by the nature of the beast, we're going to see a slowdown eventually. It's coming. We've been on a run for so long. The question is where it's going to hit and where it's going to hit the hardest. I do believe some markets are going to just resist a little more because of just what's going on with the pandemic. So I'm investing heavily in New Jersey because certain areas, even like Essex County, believe it or not, they have certain foreclosure laws where they are expediting if it's vacant or if it's a commercial property, they will expedite the foreclosure so you can get access to it. But certain areas, they're making the exceptions that are necessary to keep the economy going because they've got an influx of people. San Francisco, same thing over Bay Area, with Oakland area and stuff like that. So areas like that, Texas, Austin, they're going to be less impacted by this. But we as note investors, that's what we look for. So if you understand the way we invest, we look for places that are going to be less impacted by the ever looming, it's just how it goes, ups and downs that happen, whether I'm old enough to have lived through it, so it's coming, period, amen. And so the question is, are you prepared for it? As a note investor, what we love investing in places like Michigan, Indiana, because historically, they're only going to go up or down about 5 or 10%. Areas like Florida, you're going to see them drop like falling knives sometimes if it really gets bad. So you have to make sure you protect yourself. And with that said, note investors, what we do get is we get discounts on everything we buy. So typically what you're going to find is that we're going to be in what I like to consider recession-proof investments because we're not buying at market value. So we're buying at discounts such that we're typically in these investments about 33 cents on the dollar. And so if you can imagine, I have yet to see, period, amen, no matter Great Depression, extra special super duper depression, I've never seen properties drop 50, 60%, right? And so when you will get in at that low price value, then you're just ready to ride out the wave. And so what that means for us in the note market is more distressed inventory. And so that's good news for us because we're going to get more inventory, whether we're in a market that is upside down. That means these people are going to be distressed. Like Kaylee mentioned, there's a lot of people that are going to be over leveraged. They're going to have put too much money into this account. It's time for them to sell. And we don't buy the property. We want to buy the note portion of it. So you have to respond to us. Right now, what's interesting during even the pandemic is everyone's worried about paying who? The bank. Everyone's worried about paying the bank, the landlord, the tenants. They're all worried about making sure that people like us are getting paid. So we sit back and we wait for everything to settle, and you guys figure out how to pay us.
If I can kind of piggyback off of Jasmine's comment, is that so I got my license in 2005, and I would say 2008 was when that recession hit. 2010 is when I got bombarded with a whole bunch of foreclosures. Like it was nonstop. It was one. It would just. I think I was doing like literally.
It was the business now. Your business was the
I tell my kids, I was like, if daddy's busy, there's a lot of bad things going on. Unfortunately, it's just a lot of people losing their homes and stuff like that. And so at one point in December, I think it was December of 2011, I literally did a property a day for every single day for the month of December. Like it was just ridiculous on how many people
could do that.
And about a year or two ago, I spoke and I said, listen, 2022, 2023 is going to be like 2010 kind of ordeal. So, you know, just
what you do need are people on the ground like Navid. That's why I'm excited to meet him. People who are there. So people like us, we're in our homes in San Diego, wherever we are, just minding our business, but we have investments nationwide. So Navid is someone who I heavily in my NAP Nation want to contact for BOTG, boots on the ground, because I have notes in Pennsylvania. And guess what I do before I buy them? I call people like Navid and say, what's going on in this neighborhood? Because he knows street by street where it is, whether it's gentrifying, whether there's a Starbucks being, you know, or a Whole Foods being put up or not. These are the things I want to know before I buy the note. And then on top of that, I'm going to get a discount. So if something happens, Navid is a person that's going to handle all that stuff for us. So that's what's important, is that we all work as a community together, because it's really an ecosystem, whether, again, from Texas with Louise to Kaylee and her REITs. It's all an ecosystem. We have to get the product through the system safely, and of course, take care of the people inside of it, which is the humanity part of it.
Thank you, Jeff.
I will actually second what you just said a second ago. You are more experienced than I am, and I listen to really old people. So for me, what I've heard recently is the top 7 economists on the planet, they've all agreed, which never happens, right? But exactly like you said, we're going to start seeing all these things happen June, July. That's when it starts. Now, I think the really big distress that we're going to see, just like you had mentioned, is a year after that or so. So they had all agreed that in 2023, we're going to start seeing stuff hit the fan. So if you're not prepared, or if you're not in a fund, if you're not in a REIT that's buying these types of distressed assets or ready for it, or have people like Navid who are ready, Jasmine who are ready when this comes, you know, you're going to miss out.
Thank you, guys. You know, we're at the end and there are some more questions, but we're going to copy those questions and we're going to send them over to Brittany, and Brittany's going to answer them back to all of you guys that did ask those questions. And I do apologize that, but we are 4 minutes past. So again, I will copy those questions and we will send them out to Brittany. Okay. And she'll just dispatch them out to the people that need to answer them. Brittany, do you want to say a few words about possibly your next webinar that's coming up? Do you have an idea as to what you're going to be doing?
Yes, and I'm not sure if you have the date on hand, but it's on my calendar. I don't recall the exact date. It is, I believe, the end of April. So it's about a month from now. The third and final session in the educational series is going to be yet another panel. So you don't have to listen to me again, with some actual self-directed IRA investors themselves. They're going to talk about some best practices if you have a self-directed IRA for managing your account. You know, what have they learned from experience? What are some things to make sure that you do, what not to do? So we're looking forward to that as well, end of April. And I'm sure there will be more emails sent out on that in the coming weeks.
Correct. I want to thank you all. You guys were all great. Really, you really were. And we will have this video out for everybody to review as well and share amongst whoever you want to send it out to. Once again, thank you all. And thank you.
Thank you, Anthony, and all for joining us.
Thank you, guys. Good times.
Thank you, everyone.
Have a
Take
great
care,
day.
everybody. Bye-bye, guys. Bye-bye, everyone.